most people think about investing, they think about the same names, and some include Apple, Amazon, Nvidia, and Google. And don't get me wrong, those companies matter. They've created enormous value over time. But there is a part that a lot of investors miss. The biggest stocks don't always deliver the biggest growth. And before you get upset with me, just let me explain. Some of the strongest returns in market history came from places that felt too small, too unfamiliar, or just too unconventional at the time. And we're not just talking about smaller stocks, we're talking about different types of investments altogether. So in this video, I want to talk about 5 small investments that could outperform the biggest stocks this year. So go ahead and turn your volume up and pull out your notepad because we're about to dig in. Investment number 1, alternative investments. This asset class is where people either lean in or take a step back because it's a little bit uncomfortable. Basically, alternative investments are anything outside of stocks and bonds. And while there's so many types of assets like this that are out there, I'm just gonna name a few that I've covered on my channel. If you have a lot of cash ready to be invested, here are 2 you should consider. Number 1, parking lot investing. This is where you own or lease the land generated from parking and earning steady income with very low operational costs. Or number 2, private lending. And this is where you act as the bank, where you lend capital directly to individuals or small businesses that need the money. And for your reward, you earn what's called interest income, and it's typically secured by an asset. But if you're just like everyone else and have a modest amount of cash ready to be invested, here are 4 you should consider. Number 1, fractional real estate investing. This is where you own a percentage of a larger real estate asset like residential, commercial, or industrial. And the reason this falls within this bucket is because you don't need a lot of capital up front. Honestly, you could even start with $1,000. Number 2, water rights. Look, I get it. This one's a little bit sus, but hear me out. But this is where you invest in legal water rights or sell water usage. The reason this works is because everyone's always going to use water and it's going to have long-term demand. Number 3, car flipping. This one's a little bit self-explanatory, but you buy undervalued vehicles, fix them or improve them, and then sell them for a profit. And number 4, music royalties. Is very similar to water rights, but with songs. But for music, you own the rights to earned income every time a song gets played, streamed, or licensed. What all of these alternative investments have in common is very simple. They're tied to real demand, not just market narratives. Here's the thing, these investments do carry more risk, but you know what that means? It carries more upside. But don't worry, I broke down all of these alternative investments on my channel. So if any of them catch your attention, I encourage you to check them out. But to wrap up this asset class, if used correctly, these do not replace stocks, they just complement them. Investment number 2, micro-cap stocks. Micro-cap stocks are companies with small market capitalization, usually under a few $100 million. Don't get me wrong, these are real businesses, they're just very early. They don't get a lot of analyst coverage and they're not on a lot of financial TV. And they're usually ignored until they hit their glow up stage. But when growth shows up, that's where the opportunity comes from. Think about it. When a $1 trillion company like a bank grows, the stock barely moves. But when a microcap company signs a new contract, improves margins, or becomes profitable, that stock begins to skyrocket. And the reason for that is because the base is so small. The goal here isn't hype, it's just execution and getting in early. Examples that investors often study is a company called Air Test Systems, or they typically dig into niche industrial names like Park Aerospace. And just like with anything else, nothing's guaranteed, it's just a case study and for something you can think about. To summarize, microcap stocks are about getting in early and then letting time do the work. Investment number 3, emerging markets. Most US investors are heavily concentrated at home, and some of the fastest growth areas are happening around the world. Basically, emerging markets are countries where the middle class is expanding fast. It's the perfect blend where infrastructure is getting built there as well as customer demand is accelerating. I will say, these economies are earlier in their growth cycle, meaning they can grow faster than these US giants. And many of these stocks are still undervalued because they're just unfamiliar. And unfamiliar doesn't mean bad either. But what is bad is thinking that this is risk-free. When it comes to emerging market, there's a lot of political risk, currency swings, and then regulation matter. But with selective exposure, it gives you access to the same growth cycle that a US giant may never see again. If you're interested in investing, one fund that I like is iShares MSCI emerging markets ETF. This ETF allows you to take advantage of multiple regions, not just focus in within a specific market. And it still allows you to take advantage while consumer growth is still unfolding. Sometimes the strongest growth stories aren't domestic, they're just unfamiliar. And this is why the most valuable investment you can make doesn't start with a ticker. It starts with understanding how money actually works with different asset types. But that is exactly what this channel is built for. Breaking down opportunities that a lot of people don't think about before it gets too crowded. I encourage you to lock in so that you can hear about the opportunities that are being broken down before it gets too crowded. Appreciate your continued support. Let's finish strong. Investment number 4. Dividend growth stocks. When most people hear dividends, they think slow and boring. Even though I have an entire video covering this, I'll quickly go over the basics and what this means for you. Basically, these are companies that pay you a percentage of their earnings as a reward just from owning a piece of their company. And oftentimes, they'll raise a percentage of their dividend yield as the company grows revenue and cash flow. The real power here is compounding, so it's not something that you can just flip overnight. And while it is a long game, you have to be patient. And with this asset class, you're not just collecting income. You're reinvesting it, buying more shares, and continuously letting the dividend income stack over time. Companies that raise dividends tend to be more disciplined. It's because they generate real cash and manage debt carefully. And they reward long-term shareholders. And if you stay invested into their stock, there's opportunity for price growth and dividend growth because they reward long-term shareholders. The markets are going to be volatile, but your consistency beats your excitement. And finally, investment number 5, small cap and niche ETFs. If picking small individual companies feel overwhelming, this is where an ETF comes in. Small cap and niche ETFs allows you to invest in dozens, if not hundreds of companies all at once. Instead of betting on one name, you're betting on a trend, a sector, or a growth cycle. Many investors use funds like iShares Russell 2000 ETF or a Vanguard small cap ETF. This allows you to have access to multiple small companies while managing risk effectively. It's not the most flashiest investment, but it is the most efficient and protective for your wallet. Now let's wrap this up with practical takeaways for this year that you can apply. Number 1, alternative investments equals real demand. These work because they're tied to everyday use, not market hype. And cash flow comes from real behavior, not market sentiment. Number 2, micro stocks equals early positioning. Smaller companies that you invest in move a lot faster than the big giants. When execution from the company improves, the stock moves a lot faster because the base is small. Number 3, emerging markets equals growth cycles. These economies are in earlier development. That means faster expansion and more upside than mature US giants. Number 4, dividend growth equals compounding. Rising dividends plus reinvestment quietly stacks returns. It's boring, but it does often win long term. And number 5, small cap and niche ETFs equals smart options. You get growth themes without betting on one company. And the best part about this is it blends diversification and upside at the same time. The mistake that a lot of people make is waiting until something feels completely safe. By then, the big giants are already gone. Small investments aren't about gambling. They're about seeing growth before it becomes obvious. And the investors that understand that difference are the ones that outperform everyone else's portfolio over time. But appreciate you watching. I hope you take care, and I'll see you in the next one.